Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. If you're looking for solid investment ideas, it helps to keep an eye out for what the smart money is doing. And when it comes to smart money these days, it does not get much smarter than the Parag Parikh Financial Advisory Services Limited Mutual Fund, or the PPFAS Mutual Fund as it is popularly known as. The social media is abuzz with how the fund is moving into a few defensive names of late. In fact, the race to inform the subscribers of these names and analyze each of them in detail has already begun. Well, I don't mind sharing my own perspective, and this is precisely what I'm going to do today. Now, one stock purchase that has raised the maximum eyebrows happens to be the domestic coal monopoly, Coal India. On the face of it, this seems like a good move. The stock is down almost 30% from its 52-week highs and commands an attractive dividend yield of 6.4% at its current price. What is more, the balance sheet continues to be rock solid with almost zero debt. The performance in recent years has also been quite good, with the company consistently notching profits well in excess of rupees 300 billion as opposed to the rupees 160 to rupees 170 billion it used to earn earlier. Now let's keep aside Coal India for a bit. Let's focus on another company, and let's call this company as Company H. Now Company H is also the biggest player in its industry, much like Coal India. Its similarity with Coal India does not end here though. It also has zero debt balance sheet and also pays out majority of its profits as dividends. On the return on equity, or on the ROE front though, it is Coal India that has better 10-year as well as 5-year average ROE. Besides, Company H's profits have also not doubled over the last few years like they have for Coal India. If given a chance, where would you place your bets? Would you invest in Coal India as it has better return profile as well as growth numbers, or would you hitch your wagon to Company H based purely on past and present performance? Well, here comes the shocker now. Company H commands a P multiple that's more than 7 times the P multiple of Coal India. Yes, that's true. Investors are willing to pay 7 times more for every rupee of profit earned by Company H as compared to Coal India. Now, before I go further, let me reveal the name of the Company H to you. Well, it is none other than the FMCG behemoth Hindustan Unilever. It is Hindustan Unilever that is available at a 7 times more P multiple than Coal India, with the former's P multiple being 50 times as compared to the paltry 7 times price to earnings multiple that Coal India is currently trading at. Now, why this huge divergence, you may ask? Why, despite better past and present performance, Coal India is trading at such a huge discount to Hindustan Unilever? Well, the answer lies in the fact that Mr. Market values future performance more than it does past performance, and as far as the future is concerned, Hindustan Unilever seems to be on a much more solid footing than Coal India. One of the main reasons is earnings visibility, or the existence of the business itself. There's a strong chance that 10 years from now, Hindustan Unilever would still be around and would be making significantly higher profits than now. And it is this greater certainty that is worth its weight in gold for investors, and one of the big reasons why it commands a huge premium over Coal India. On the other hand, Coal India's past and present may have been great, but its future does not look as bright given India's shift towards renewables and coal's reputation as a polluting source of energy. Besides, it is a true blue PSU where it is often seen that shareholder interests are sacrificed at the altar of populism or vote bank politics. Put differently, the tendency of Coal India's management to steer the company in a direction different from shareholder wealth creation cannot be denied. Having said that, both these concerns can also be seen as being blown out of proportion. For one, Coal India is here to stay, as majority of our power will continue to be generated through coal-fired power plants for quite some time to come. In fact, government has plans to augment India's thermal power capacity by more than 80 gigawatts over the next 6 to 7 years. This means that Coal India has a good shot at not only maintaining its profit numbers but also growing them at a good rate going forward. Secondly, agreed that it is a PSU and agreed that at times it may take decisions that would impair shareholder wealth creation. However, there is no denying that it is a giant monopoly with rock solid balance sheet and a more than liberal dividend payout, and that too on a consistent basis. Therefore, it is certainly worth something even if it does not deserve a multiple as high as its private sector counterparts. Now, historically, that is from a 10-year perspective, Coal India has commanded a median price to earnings multiple of 8 times and a median price to book value multiple of close to 4 times. Currently, its PE is around 7 times and its price to book value multiple is close to 2.5 times. Now, for a stock like Coal India, whose earnings are cyclical and can vary quite a bit from one year to another, valuing the stock based on price to book seems like the more apt thing to do. And based on this metric, the valuations don't look all that demanding. Is Coal India a 10-year bet or more like a 2 to 3 year bet where you make your 50% to 100% and move on? Is this the right time to invest in the stock or should one wait for it to fall further? Well, there are never any easy or clear answers to this question. It is all about risk reward and about minimizing your downside and buying with a margin of safety. Now, unfortunately, this is not the place where I can give you a clear buy or a sell view. In fact, I don't want to do that at all. All I want is to lay out the facts in front of you and try to interpret them through the lens of my experience and my framework. It is you who will have to take the final call. So here's wishing you all the very best, and I'll see you again in the next session. Goodbye and happy investing.